G'day and welcome to this week's video. My name is Robert Gowdy from Consortium Private Wealth, and given the huge amount of turmoil we've seen of late, given the coronavirus-inspired share market crash, I thought it'd be worthwhile for us to go back and just have a look at what I'm looking for and have done for the last 20 years. What I'm looking for in terms of quality investments, and closer to the point of what I'm looking for quality businesses. That is our preferred area to invest over and above property and cash and the like. If we want great, strong-term, long-term returns, then businesses are the spot we like to invest. And of course, we're talking about the share market. So I've got 7 things that we look for, and I'll give a bit of a guide on where to find some of these things as we go through the process. Number one, top of my list here is obviously products and services that people value and that are used. And I think the coronavirus and the shutdown have seen lots of services that once have been used regularly on a daily basis not used as much. Airlines, for one, they've essentially shut up shop for the time being. No international travel, and it's going to be quite some time before international travel kicks back up again. But at this point in time, those products and services are just not being used. Therefore, revenue crashes and profitability obviously goes down very quickly. On the other hand, I'm using Microsoft Teams right now to do this video recording. So Microsoft Office 365, Teams, Skype meetings are being used more than ever. And this will really set a tone for and habits to how people use these products moving forward. So it's more than likely that whether it's Zoom or if it's Microsoft Teams, Skype, they'll be used more regularly as habits are formed. Number 2, competitive advantage. Well, clearly, I'm using Microsoft here. 90% of Microsoft products are used within 90% of the businesses around the world. So that is a real competitive advantage, and nearly say that it's a monopoly. That if you're not using Microsoft products and you're trying to send through Google Docs, they're just not widely used. And whilst they might be compatible, I don't know. I've only really used Microsoft in the past, but I know the rest of the world is using their products. And there is a shift into the cloud, where we made this shift probably 3 to 4 years ago using Office 365, and we've upgraded the services to give us live webinar capability. Soon we'll be able to complete all our phone calls via Microsoft Teams. So there's some real competitive advantages, and because the product offering is so strong, it's highly unlikely that we'll ever look to leave, for at least for my small business. And when I look back at the products we used to use, when we had online booking, we used to use a product called Time Trade, where we used to spend $400, $500, $600 to that business for online booking. Of course, Microsoft had an option for that. We used to use Wufoo for that was online forms and feedback from clients. Microsoft within Office 365 have a version for that. Obviously, I can see very soon that my Telstra bill will reduce, because I won't need to have Telstra like we have in the past, because I'll be able to do so many phone calls through Microsoft Teams. So these are the competitive advantages. Number 3, the ability to scale the business. I won't keep talking about Microsoft, although because I will do a bit more in the video. The ability to scale, and that's where businesses can sell more of their product without increasing their cost to deliver the product. So a good example of the ability to scale would be a business called Magellan Financial Group. It's been about for the last 12, 13 years, and they've gone from a very, starting from 0 funds under management 12, 13 years ago to just under $1 billion at this point in time. It's run by Hamish Douglas. and yeah, been extremely good at what they've done in terms of funds management. They take people's money and they manage on their behalf, along with many thousands of other investors. So what they could take on, probably another $10 billion worth of money to manage right now. That would bring in a lot more fees based on their fees are based on a percentage of the amount that they're managing, but they would not need really to change their cost base by much. They probably would not need to hire any more people to manage, an extra $10 billion on top of the $100 billion that they've nearly got at this point in time. So I think we think about software is very scalable. Obviously, funds management is a scalable industry as well. So yeah, a business that can increase their revenues substantially without increasing their cost materially is scale, and that's something that we look for. Making sure that management have some meaningful ownership in the business, I think aligns themselves with their fellow shareholders. And I think Hamish Douglass at Magellan again owns a substantial amount of the business, well over 10%. So I think it was a politician said many years ago, it's always worthwhile backing self-interest. So if we think that Hamish is going to do the right thing by himself and his family because of his ownership in Magellan, I'm pretty comfortable he's going to do the right thing by myself as a fellow shareholder. So yeah, seeing that the people running the show have an interest and have their own money on the line as well, skin in the game, is really important to me. Now, what we'll do is we'll start to look at some of the I suppose the financial side of things, which is really important, and this is where we will go back to Microsoft, and yeah, earnings and profit growth is absolutely exceptional, and a really important part of what we're chasing here, because at the end of the day, I firmly believe that it's the future cash flows and profitability of the business is one of the fundamental ways, 90% of the way that we value any asset, whether it's a commercial property, it's the lease that comes in, the net lease after all the cost. We apply a percentage to that to give us a value. So if we've got a business that's scalable and growing its revenues and therefore profitability, which we can see Microsoft has done, mostly over its time. But if we look back here at 2010, its earnings per share was $2.06, and it's grown that to nearly $5 as of the end of last financial year. That is, huge earnings growth. Because it's software, it's very scalable. The profitability generally increases in percentage terms, well above the costs, which gives us these great results, and therefore the value of the business grows. Return on equity is probably one of the key measures that we look for. Anything above 10-15% is what we're chasing. This is software called a share analysis. You can find this information on lots of other sites. Here's a free site where you can go on to, this is just Yahoo Finance, and you can get a lot of this information for free if you scale the net. But yeah, Yahoo's definitely a spot. If you want to find out whether directors and management own parts of the business, I think it's well worth going to review their annual reports. They need to disclose this, or you look at some of the ASX reports. When a director makes a share trade, they have to disclose that to the market. So that will show what they currently own, what they've bought, and what their current holdings are. So that's a way you can do that. But if we go back to return on equity, you can see that we're in Microsoft here, that the return on equity is over 40%. We're happy with 15% and above. 10% is adequate as well. But you can see your forecast earnings growth is looking good. This is based on what a lot of the analysis that people out there that are researching the business look for, and these are some of their forecasts. Again, the forecasts we can get within Yahoo Finance as well. This is all free. We can get a bit of a guide to know what the analysts think. And you can see here, there's the amount of analysts that are looking at Microsoft at this point in time. So we can see the return equity there is fantastic, and that is exactly what we're after. We're also after, I suppose, a strong balance sheet. Now, it's times like these when definitely things become tough, revenues come back for some businesses, and if they're swimming in debt, they can't repay those debts, that could well be an issue. So if we go and have a look here, and again, I'll show you in Yahoo Finance as well. So we can see that we've got debt here within Microsoft of 78 billion, I think that is, but we can see they've got cash and short-term investments of nearly 134 billion. So net cash of 55-60 billion dollars. So extremely strong, and that's something that helps us make sure that the chances of this business going broke is highly unlikely. So we just go back to the summary here, back to the financials, and this is where we can find the balance sheet information here in return to cash. There's the short-term cash and the debt side of things just down a bit further here as well. Another important thing for us that we can look at. I mentioned that we can see there's analysts here. This is another thing that I look for. We've got 24 analysts providing an opinion. Generally, that gets down to a buy, a strong buy, hold, or underperform or sell. You can see here the large bulk of the analysts here are saying that's been between a strong buy and a buy, and only a few hold. So a lot of the analysts are a great believer in this business for obviously a lot of very strong and compelling reasons. So these are the sort of things that I'm looking for as an investor, as a financial advisor. I'm using lots of different tools to help me with this, and reading constantly to see what fund managers think, what businesses they're looking at, and that is a starting point for me to start my research. So I hope that's a help, and it gives you a bit of a guide to what I'm looking for and what we do here for our clients to make sure we're finding really high quality businesses. I will make one point around dividends. That is a conversation I have all the time with my clients, that I'm not overly not tracking dividends. That is not a real focus for myself. I've seen many circumstances where businesses are paying out a very high dividend, and Telstra, the banks of late, but Telstra in the past has not heavily reinvested back into their business. So dividends do not feature as one of the compelling things I look for. I'm looking for the sector, which is probably point number 8 that I missed. Needs to be a decent sector, not a sector that's going out like obviously cassettes and rental video shops in the past. But dividends is not high on the list. I want businesses that pay, say, a smaller dividend, that reinvest heavily back into their business for future growth. So obviously a bit of a long-winded video. Thank you for your patience and thank you for listening. Please provide some comments. Always happy to answer any questions that people have got, or any other suggestions that you might have with regards to any topics you'd like covered. If you haven't subscribed to the channel, please do. That'd be great. And for those that have, thanks very much, and we'll catch you soon. Bye.